All right, well, let me go ahead and get started. I'll give you guys a brief overview of what I'm expecting and how I intend to play the markets with that. So the big news, which we pretty much were told was going to happen from Goldman Sachs, funny enough, was that the Fed was going to have to do a one-time injection of capital into their balance sheet, which just means the banks can get out of these bond positions for a huge profit and free up capital. So they've been saying that would happen for about a month, and yesterday came out and said, hey, it's not QE, but we're going to grow the balance sheet. So it's really the same thing. And that's been the laughing stock of the internet today. But that's a big move. And what's important about that is that usually we do quantitative easing after dropping rates to zero, and typically don't go to QE until after a massive stock crash has occurred. So that's what happened in 2008, and also what happened in the dot-com bubble. Fed was pretty good at predicting a recession before it occurred, was aggressively dropping rates, but nothing was fixed until they printed money, freed up all the bad loans, got freed up on the bank's balance sheets, swept under the rug, and then they could go in with fresh ammo and buy up assets. And the last two bubbles were really domiciled in the US with the dot-com bubble and then the mortgage, all those mortgage products where they take tons of different mortgages, wrap them into a single loan, and then go sell those to the market. And so this time around, it's China's misallocation of capital, and it's to a much bigger degree than the US had in the previous two crises. Now, what's interesting is you can see the dot-com crash took about 2.5 years to recover. The 08 bubble only took about a year and a couple months. And the big difference was just how fast they were ready to go expand the balance sheet. And this time around, you can see they're not going to wait at all. We're close to all-time highs. We're dropping rates, and we're aggressively putting money in the system. So that's extremely bullish for the SPY without, of course, major disruptions to trade, which could possibly be in the books. So that's the hard thing to predict right now. But what's neat is it gives our TLT a huge amount of support. The chances of rates dramatically spiking during a period where the Fed is about to pump probably $1 trillion, maybe half of that, maybe up to $1 trillion in the next 60 days. And then they're going to try to manipulate the yield curve to be healthier. Right now it's inverted. It gives us the PAL put on the TLT. And so if we have about half our portfolio in the TLT, we can have the courage to be long potentially a much more valuable asset, which would be the SPY. So we can hope for big gains in the SPY because we know all these banks are going to be having fresh powder here in the next few months. And if something goes wrong, really the only thing I see going wrong at this point would be the trade war escalating. So if the trade war dramatically escalates, that does cause some short-term selling. And as we've seen, every time they escalate, markets sell off. So that's the hardest part to predict, but it puts us in a nice position to take the risk of being long the SPY and have the next, it's not a completely risk-free trade on TLT, but I'm not too concerned about the TLT going down right now because of QE being in place. And then if there's any kind of positive development in the trade war, the SPY can rally significantly higher at this point. So that's kind of our setup right now. Let me see what other important charts I covered. So SPY, you can see that is really on the verge of a massive breakout, considering the money supply is growing dramatically currently. TLT most likely will be boring. I think most of the gains are in for the TLT unless the trade war escalates. So if we go back to trying to just calculate in my head quickly what kind of profit we could get in the TLT in the next few months. If we go back to October, I'm trying to remember the exact rate. I think we're at 3.5. So to get from 3.5 to 2, the TLT went from something like 120 to 147. So we put on about 28 potential dollars points on the TLT for a 1.5% move. So if this were to drop to say 1.5 to 1% rate, there's probably another $10 to $20 of potential profit on the TLT if we do continue to push these yields significantly lower, which I think, unfortunately, for most investors, is probably the most likely outcome. And most retail investors have no idea they don't understand the point of the TLT, or much less what it is, or how powerful it has been over the last several decades. To just blindly own an equal weight in the SPY and the TLT has been an incredibly powerful strategy that makes it very hard to have a losing period of time. So from that outlook, relatively low risk on a massive sell-off on the TLT. But if we get bad news with the trade war, it could significantly rally from here. But meanwhile, I'm still going to be skeptical to believe there's too much of a long-term sell-off in the SPY unless the credit market starts to crack. So there's 3 ETFs you can watch to get a glimpse of the credit market. The TLT is the most important one, but will probably be the last to react. And then we have the LQD, which is the investment grade corporate credit bond ETF, and then the HYG is the junk bond. So most likely we'll see the junk bond market see its rates soar first, then it will start to leak into the corporate, and then I would suspect the TLT would be the last one to sell off. Now, if those start to sell off, that means these corporations can't get free credit, and they're going to stop buying back their own stocks. So that's when I would start to predict a more long-term sell-off in the SPY. Until then, I think any kind of trade talk scare is going to be a good buying opportunity. So we'll play the downside with our upside down callers to the downside, and then quickly rotate back into being long the SPY after we hit these different levels. So Nomura Bank is my favorite technical analysis. Huge bank out of Japan. They're very good at figuring out where the CTAs will buy and sell based on different levels. So right now, their magic mark line in the sand is 287. If we go below 287 for several days, that would cause all these short-term trading machines to significantly switch to selling the SPY. And I'll have to get an update on to where they would flip back to buying it. But there could be a pretty sizable sell-off in the books coming up for the SPY if we get some serious negative headlines out of the trade talks. And most likely we will, but again, it's hard to predict that. Meanwhile, I love GDX currently for our buy and hold position, 10%. We're not selling calls against that because we don't want to miss out on the big jumps. And just to get back to the 2012 levels, 66, I think we're going to go much higher than that because the problems are much larger than the 08 crisis, where it was just, U.S. housing bubble. Silver, again, we're looking for silver to get to 22 to 25 spot price and then rotate out of the SLV into SIV. Now, once that happens, I will try to not sell that position for at least a year so that we can have a smaller tax obligation. So unfortunately, I don't think we'll be able to get that long-term tax break on SLV because I do want to rotate into SIV in the near future. So if you
Hey, Jason.
Yeah?
I'm just going to interrupt you for a second. SIV, I can't find that, but I can find SIL as my.
Oh, it's SIL. My apologies.
I was going to say, yeah.
I've been saying that in all the damn webinars. Good catch.
All right, just was double checking because I was trying to prepare. Okay, thanks.
Sure. So if you would prefer to have the better tax break, you could rotate it into SIL, and there's just about nothing I could see for us to want to get out of the precious metals. We'd really need to see a comprehensive trade deal closed, and at that point, even then, I don't see the banks switching the QE. All the damage that's been done to the trade routes and the effect of quantitative tightening is still reaping its havoc through the financial system. So my expectation to get out of precious metals is slim to none. But I'm open-minded. We get a comprehensive trade deal. We'd probably want to focus on being long equities, and the banks are set to print right now. So that's hard to predict. Secret
Can we talk
empires
silver for just another second? Because I'm curious about your thoughts on something.
Sure.
I know you keep saying that you believe it's going to go up to, I don't know, 22 or 24. What I can't recall exactly the number you said, but I know there used to be for forever there was this gold to silver ratio thing, but I'm just wondering if that even applies anymore to any of this stuff with all this QE infinity that's been going on. Has it affected any of that type of ratio? I just don't know. Sure.
Yeah. So gold leads, usually the bigger asset lead. Like look at the SPY, for example. Those top companies that lead the market, like Microsoft, Apple, and then the little guys catch up. It's not the other way around. We're not seeing the little guys have big bounces in price, and then the big guys catch up. So gold's the big guy in the precious metals, silver's the little guy. And if we just look at the chart, you can see this visually pretty easily.
Actually, it's just it's so different with precious metals compared to other types of holdings that there's always been this correlation forever, way before any of us have been around. But it just seems like I'm wondering, since all this changed the way our monetary system is and across the world really, and how all this new currency exposure, just all kinds of things have changed so much. I'm just wondering if that dynamic has changed as well. And we may be looking for something that may not actually happen the way it used to, but I mean, I could be wrong. I'm just questioning with all these, with everything that's changed, so much in the manipulation of currencies, etc. And silver is so different than gold anyway, because it's also industrial. So I'm just wondering if that has any relationship to.
Sure. Yeah. So silver lags gold. So again, the gold's a much bigger market cap than silver. So gold will rally first, and then silver will follow. So I would say yes. I like the silver play. And you can still see very correlated, just gold's acting stronger because it's a much more important asset.
Okay.
And so expect silver to lag behind gold. Yeah, trying to time it perfectly can be difficult, but yeah, so you can see gold had that rally, a pullback, and then rallied to new highs. Mm-hmm. Silver had a rally, pulled back, and now it's getting ready to rally to new highs.
Okay. Thanks.
Sure. Okay, so Secret Empires, good book to read. Came out a year or two ago, and I learned a lot more than I had known about how the different politicians take advantage of their spot in the government. And the big thing I got from that was this concept of smash and grab, smash an industry, and then have your buddies go grab it. And so I think that could potentially be the plans, is to try to smash these Chinese equities much lower and then buy them up at a discount. So that's why we put on that put option on FXI. Plus, I was seeing the terminology come out of the administration I wanted to hear, which was, a few weeks ago, we heard rumors they're going to delist Chinese securities. And we got a pretty nasty sell-off on Alibaba. not much on FXI. And then quickly the White House said, oh, that's fake news. And then this week they came out and they sanctioned 16 companies. We got the NASDAQ tightening the rope on IPOs. And then we also heard them talk about pensions restricting capital. So it does seem like that will be a quick move that I thought might be delayed, but we got that news this week, so we're positioned. So 1% total position. If we don't see things escalating next week, I'll probably sell that put for a loss. Otherwise, I'm happy to hold on to it. It was, I think, what was that strike we did?
32.
32, I think February 21st. So we got a lot of time to hit that one.
Yeah,
but if we don't see things starting to really escalate by next week, we'll sell that for a loss. But again, that's an extra hedge for us to bet up on the SPY. So we got the TLT protecting us, we got gold protecting us, we have silver protecting us, and then potentially a very large return on that put on FXI. Okay, there's your dollar. Here's your cryptos. Oh, I think I forgot to screenshot the currency. So that futures trade on the currency could be coming up soon as well. But we really got to wait for Friday to transpire and see what happens. Some headlines. So just all the headlines coming out are negative. We've got the NBA getting a lot of drama now. We have NASDAQ making it more restrictive on Chinese IPOs. We had, on the positive note, we have QE, jobs market, you know, a little bit of a slowdown, but we're still at record unemployment. Productivity is picking up. So really things look good from that standpoint. Some positive headlines on crypto. Then some more drama with the NBA. Both sides are restricting visas, so the decoupling it's all happening very quickly. Plus they sanctioned something like 28 companies this week. And the only good news is that the Chinese said they will buy more soybeans, but the amount of soybeans they're offering is actually, I believe, I'd have to double check, but I think it's less than they're offering to buy before the trade war began. So it looks like they're trying to, they're not seriously trying to create any sort of deal. I think they want to make it look like the U.S. is unreasonable to the public who isn't paying close attention. So that the chances of the trade war being resolved or delayed, I think, are relatively low. But we still put on the bullish trade today just because QE is in effect, and without the bad news, the market does, you know, we've seen it every night. The SPY pops up and then we have some negative news and it comes back down, and then it wants to pop up in the futures market and it comes back down. So our setup still is vulnerable to bad news on the SPY, but we're protected in so many different ways. Now we did have a nice return of 1.1 yesterday because of the TLT being up so much, but then we got that positive trade news that put the SPY right to no benefit to us because we were already cut off on the losses at 292 from the previous trade. And on the other hand, we lost some of the profit on the TLT. So yeah, that's pretty much where we sit today. Now the trade setup we're going to want to do if we think the SPY is going to travel lower will be that in the money covered call. So we'll sell the in the money covered call. Let me find the example of the TLT where we did this exact trade setup just to make sure we're all ready for it. Any questions so far? We have some more members in. Let's see who's in.
Yeah, Jason, question. This is Oscar. Yesterday you did talk about getting into the reverse covered and the reverse the covered call SPY put position. But you kind of went on the bullish side today. Is that a reaction to the news from China?
Well, yeah, I want to play the downside on the SPY, but it's just so hard to bet against the SPY that, yeah, I'm waiting for bad news to flow, because if we get some sort of, I don't think we're gonna have any bad news till Friday, basically. So with that expectation, I think the SPY is oversold and has an easy rally ahead.
I must have missed the FXI trade.
Sure,
When
let me
did you
pull it
put
up.
that out?
You can get it at a discount today because it did rally a little bit. And we got some more members in. Welcome, everybody. How's it going, Ernest?
Great, thanks.
Okay, so here's the trade. I put 1% in this position. So this is another reason we have the confidence to be long the SPY. Is this position 32 strike? I think FXI jumped up a little bit today. Let's see where it's at. Yeah, so it jumped up a little bit, nothing big. So you'd probably get it for a bit of a discount.
Mm-hmm.
So yeah, this could go up several 100% depending on how far FXI could drop. It could go up over 1,000% if it drops really, really significantly. And if we don't get an escalation, I will sell it for a loss next week.
And I was wondering why you chose such a long expiration on this if, you know, but since this whole trade situation is so volatile.
Well, you know, the time premium, if I had done like December, you know, it would cost, I think it was like half. So to get the extra 3 months of time premium, I think only increased the cost by like 12 cents.
Oh, okay.
So from my point of view, I don't want you guys to have to be managing this position a lot. And I think the heaviest sell, well, it's hard to predict. I think from my point of view, the big date is December 15th. And so we want a lot of time premium left when we get the maximum drawdown in FXI. So from my point of view, if the big sell-off were to occur in around December 15th, this would still give us something like 60 days of time premium. So you basically want to hit the maximum drawdown on your option contract by the middle of the time premium. So
Okay, that makes sense. Yeah, because I know this Tuesday, for instance, I mean, that's when Trump's supposed to put on additional tariffs. So, you know, it's like we've got all these, I feel like I just, you know, need a calendar and plot all these, these FXI affected, you know, these trade war type things, these dates, and in order to make some of these decisions. It's unbelievable. Yeah, we'll see what happens. But I took it, so, you know, we'll see what happens.
yeah, you know, worst case, we lose maybe 20% on that. Well, I mean, if we get a trade deal Friday and the thing rallies a few dollars, we could lose, you know, 50% on that one pretty easy. So that's a risk I'm willing to take. But I just, you know, I don't think we're going to get a trade deal. And if you look at this whole impeachment inquiry, if Trump does create this, you know, if depending on your political view, you know, you could call it a distraction. That'd be one reason he might. If you're anti-Trump, you say, well, he's gonna go crazy on China to distract from the impeachment. If you're pro-Trump, you could say he's going to go aggressive on China to bring light to all the money that China's paid to the Bidens. So from those 2 points of view, I would say he's likely to escalate. From another point of view, their offer is a joke. I mean, it's really a joke. They're going to buy soybeans. And they're buying, even with this additional offer, it'd still be less than where we started at. So that's a joke. Trump's got the Fed supporting him now. If he's going to escalate and potentially cause a market sell-off, and then force them into a deal, and then get the markets to rally back up before the 2020 election in November, he's running out of time. So, and also if you go back through history, I've never seen him back down. I've seen him delay, he's been the lightest on the Chinese for sure. He's delayed tariffs here and there, but overall, he's been very aggressive, more so than anyone else in history with the last several presidents. So, if I were to bet, I would say there's no trade deal and things get hairy here in the next several weeks. So yeah, this could be one of our last. Let me pull up the TLT trade just so we can all be. Let me just find the dates. I want to find the upside down trade so we can look at how those shaped up for us. So that was September period. I'm doing the webinar today from my laptop instead. There's John, Paul. Hey, John, how's it going? John's no Trump fan, I've come to notice from the chat, but I just hope you know, John, I'm not, as far as my trading decisions go, I don't care, just want to make us money here. So I'm just reading the markets as best as I can here. Okay, so what I'm going to do, guys, is I just want to make sure we're all prepared for, now from your point of view, he says, yes, I feel the same way. Okay, so Thursday, I want to go back to, so as far as like the mechanical operation of how you're going to put on the trades, if we get a sell-off from an escalating trade war, it won't be dramatically different, but just some of the outcomes could be a little different. Okay, so here's your typical setup. This is totally something I've made up in terms of the terminology. I call it the upside down collar. And so the risk graph is not an accurate depiction of what our potential profit is in this case. And in fact, it understates the potential profit. Now, when we're predicting the up move, it's very accurate. But what this doesn't have a good ability to do is predict the increase in volatility, increasing the profitability of the put. So it's just looking at the closing date. If you hit these different prices, then this would be your P&L. But in our case, we're closing out the position early. And so if we're predicting a down move, implied volatility pops up and makes the relative value of our put more valuable. And so this is our safe, this is the only safe way there is to profit from downside moves with very little risk. Because if, like I said, that put option I gave you guys on FXI, if FXI goes up a few dollars next week because whatever, trade war is delayed, a truce, maybe even a real deal, we're going to lose a huge chunk of that, maybe up to 50%, I would estimate at maximum before we get out next week. With this setup, that's not going to happen. And so that's why this is a much safer way to make small profits, bread and butter returns like we've been doing all year. And so it's very simple. Instead of buying or selling the out of the money call, we're going to sell an in the money call. And instead of purchasing an out of the money put for downside protection, we're going to purchase an in the money put. And so there could be potentially a considerable amount of trades coming up on the SPY where we're going to be doing this setup right here. as early as Friday. Quite frankly, I'm thinking I want to put this trade on Friday, although we may not have the bad news out by Friday. And so what can happen is, because we're selling that in the money call option, our probability of being assigned is far greater. So if you think about it, if we sell an out of the money call, like let's say in this example, the TLT is at 144.60. If I go sell something like a 147, well, this TLT is going to have to jump way above 147 for me to get assigned. And again, one of our members, Dora, was actually wanting some clarification on this. So in our strategy, if we get assigned, that's great. We go to cash and we get the price we agreed to on the call option. So with these upside down trades, there's two ways we can make a bigger profit than the risk graph indicates. So number one, if we put on the upside down collar and the asset just starts to collapse and the day we close it, there will be some time premium. The profit we make can be greater than the stated profit because there's going to be that time premium and implied volatility has gone up. So the further it goes lower, actually the more profit we can generate. And it's the rate of change, not just so it's the acceleration and not just the total amount that it's gone down. So if we're able to close out an upside down collar during a period where the asset's really traveling down at an accelerating rate, we'll get the maximum return. So it'll be a little bit, we're not talking about substantially more, but we could potentially see anywhere from 30 to 50% extra profit than is stated in our chart. So just, that's a heads up on that. That's one way we can generate a bigger profit than the way this thing calculates. Now, even better is if the day we issue the trade alert, we're immediately wrong. So if we were to put on this trade right here, where it's TLT's at 144.60 and we sold the 144 call, the best possible outcome would be day one. So the day we issue the trade, the TLT spikes up. Let's just pretend this is the SPY for this example. If the SPY were to significantly appreciate the same day, we could potentially be assigned overnight and be into cash on the short call and the SPY. But then we would still be long our put, which was financed primarily from the short call. So the best outcome possible would be to actually be wrong on the first day we do the trade, get assigned overnight, and then still be long our put option for the next 24 hours. So if we get wrong right away, it pops up, we could get assigned overnight, and then the market dumps the next day or two. That's how we could get a much larger return that would be far greater than a 30 to 50% boost. So betting down on the SPY can be very lucrative, and this will be the setup that we all want to be aware of. So if we get assigned again, you end up in cash, your short call position is closed, and you're still long your put. So it's a great way to play this because of that. Now, on the other hand, if the SPY just keeps flying up, then we don't stand to lose that much. You know, in this case, with this current setup right here, we lose less than 1% if we're wrong, but we could make a little bit more than 1% if we're correct. And that'll be a similar setup that we can organize for the SPY. But again, we're going to be taking advantage of that 3 times a week. And during crashes, you'll see the market doesn't go down in a straight line. It does gap up tremendously and then sell off. So the opportunity for this to happen is going to be very lucrative for us. Now let's see, I got a few questions. Oh, Paul is wondering about Telegram. Yeah, we need to get Telegram running again. So definitely, Paul, I'll get the Telegram running again. And that's also another great way to get trade alerts if you're having text issues. We did a whole bunch. We basically bought a bunch of new phones and got some new apps and learned all the filtering systems of the. Is everybody getting their text messages now? because I know a lot of you are having trouble. I hope that's fixed. But yeah, I'll get the Telegram running by next week, Paul, because that was a nice feature that we do intend to put on. A lot of work's been going on behind the scenes to get our boot camp ready as well. Okay, so let's see. Is everybody clear on, let's see, we got more people joined in. Is everybody crystal clear on how the upside down collar works? Because this will most likely be our trade on the SPY, this setup. And so while it's not going to change what you've been doing for the past 11 months, just understanding the outcome and how it works, I want to make sure everybody is familiar with that. So if we get the bad news Friday and things escalate and we get below that 287 on the SPY, most likely that will cause some selling until we get to a new support level. Let's see what we got in chat. John's getting 2. Okay, I got 2 today also, so I think that was an. You're getting 2 every day, or just today, John? Because I got 2 today too for some reason. Okay, you're getting 2 texts daily. Okay, let me tell Ryan so you don't have to do that. Is it from 2 phone numbers or from the same phone number? The same phone number? Okay. Okay, cool. He's looking into that right now. Yeah, so yeah, you should get 2 text messages. One's the trailer, one's the live stream link. Is that what you're getting, Karen? Okay, good. So guys, does everybody have a clear picture of how this, how we're going to play the upside down collar? Any questions on that?
Hey, Jason, have you moved to interactive brokers?
For the boot camp, yeah, we're going to be teaching everyone in. Oh, looks like Dean's here. Let me get him on. Hey, Dean, how's it going?
Good, Jason. Apologize for being a little late, everyone. Had a couple calls I couldn't get away from, but here now.
Nice. So yeah, we're just reviewing the probability of switching to the upside down collar on the SPY if we get some negative news Friday or early next week.
Nice.
And so yeah, you guys crystal clear on this? Because this will most likely be our setup if the trade works. Now the TLT will still be the loose collar where we let the TLT rise. Same thing for silver, and then gold, of course, is just buy and hold. Okay, good. Well, you guys are pretty on top of that. I do want to point out our returns. So so from the end of July to current on the SPY is down 3.7. Meanwhile, we've been able to put up, what is that? That's 3.7% return. So not too shabby. It's been a little bit slower than I'd like in September. And that's just because the SPY keeps crashing, going up, trying to figure out what's going to happen to the trade war. And even in October, the SPY's down about almost 3%, and we're up 0.5%. So considering that, I'm quite pleased with our returns.
So who all do we have in the webinar?
Let's see, we've got, let me pull it up. Oh. We've got Ernest, Kenneth, Rocky, John, Karen, Oscar, Paul, and Tom.
Nice. Very nice team. How's everyone doing?
Great.
Good.
Doing okay. You're doing okay, Dean.
Good. Okay. Sorry there, Jason. I'll let you get back into it.
No, no worries. Let's see. I'm doing well. Well, very good, guys. Let me pull up one more thing. Just give you guys a glimpse of what I've been working on in the boot camp. Now, I do want to throw out, if you are a lifetimer, we're going to give you the first 4 weeks of the boot camp free, including that futures trade. So I know probably half of you guys are in that camp. So thanks for all your support. And if you're not yet upgraded to a lifetime membership, maybe call Dean, and we do have a nice bonus. You get the first 4 weeks of the boot camp free if you're not yet a lifetimer. Now, if you are a lifetimer, don't worry, we're going to automatically enroll you, so you get the first 4 weeks free. Here's the first module. I just want to give you guys a little view of it, because I know a lot of people are saying, well, I've got 20 years of options experience in this and that. But I don't want you to think this boot camp is going to be trying to make you some sort of options professional trader. In fact, it's not at all trying to do that. Really what we're trying to do is just try to shortcut what you do to follow the program. Imagine I'm gone. How are you going to take this strategy you've been following and learning and do it all on your own? And that's really what I'm trying to accomplish in this boot camp. Now, of course, it's not possible in 16 weeks to cover everything. But what I did want to do is just kind of preview a little bit of it today, what I've been working on. Now, it's not done by any stretch, a lot of issues with the graphics, but just hang in there. And we're going to talk about the big things I look at to try to predict the markets. And so the most important one is certainly whether the Fed is increasing its balance sheets or decreasing its balance sheets. We go look at 2018, the last time they tried to, in fact, every time they've tried to reduce the balance sheets, we've had a market scare that resulted in more QE. So let me get that little thing to pop down. So 2018 was the biggest reduction to the balance sheet we've seen. All the banks did it at once when we have 98% of all asset classes lost value. Only thing that made money probably were a few sniper shots at the VIX. In 2012, they tried to reduce the balance sheet. That didn't work. Immediately, they had to add $1.6 trillion after just a little bit of trying to do that. And then after jumping the balance sheet from 800 billion to 2.2 trillion in 2009, biggest bank bailout of all time, they tried to sell off a little bit, and that didn't work, so they had to add about $1 trillion to try to sell off a little bit, and so that seems to be the trend. Sell off a little bit and then add a couple trillion. So that's what I'm suspecting will happen in the next several years, is that they will add a couple $1 trillion. Now, I think we're going to see, in fact, Powell said this just yesterday, that they think the right balance sheet to start with is where they were at before before they tried to reduce the balance sheet. What a joke. So I think we're going to see them probably pile in about $1 trillion in November, maybe October. So that's all going straight to the banks. And again, that's why it's hard to bet against the SPY right now, at least for very long periods of time. So while I'm not afraid to play the upside down collar for a few weeks on the SPY as the trade war escalates, I'm not at the point where I want to say we're going to have a 12-month crash or anything of that nature. Not while corporations have free credit. So what causes the Fed to increase their balance sheet, or rather not increase their balance sheet? There's really just one major thing that really stops them from supporting these financial markets, and it is inflation. And it's interesting, you know, you might think going to war with China would be negative, but in fact, it's actually the repercussions of going to war that typically create the inflation. And so you'll actually see some pretty good market rallies often during conflict. And it's really when we have inflation or massive deflation that we get these big negative moves in these two assets we're playing, the bond market and the US market. And so you can see, sure, during World War I, there's a little bit of a sell-off, but right after we have this huge rally. And it wasn't until inflation hit the market and then followed by deflation, we got that nasty Great Depression. Cold War started, sure, we had a little sell-off, but that set up the banks to go into massive easing period. And we had a huge stock market rally going into the Cold War. And it wasn't until inflation came roaring its head that we had that huge long-term sell-off in the Dow, which was about 10 years from top to bottom, and then more like 20 years to completely recover. In fact, I think it was more like 30 years. Now, when you look at that, from 1965 to 1980, 15-year overall bear market in equities during the period of interest rates going up, our whole SPY TLT strategy obviously would have been crushed unless you're doing that upside down collar. Now, in my lifetime, I've only seen the dot-com crash, and during that period, I had no clue. Obviously, I was a little kid. 08 crash, I certainly lived through and actually got started in this industry at the bottom of that. But those crashes are tiny little pullbacks, mini crashes. So likely what we're going to have at some point is something more like that 1965 to 1980 period, which I think will catch most investors completely off guard, as you know, that period of time is long gone in memory. And now we think crashes last a year, and there's no reason to worry about it. They'll always rebound back. If you study Ray Dalio, he thinks we're coming towards, well, he likes to use the World War I, World War II analogy, and you can see some striking comparisons. There's some tariffs being put in place, but more importantly, the Germans were getting attacked by everyone for reparations for World War I. They had spent a fortune trying to obviously stop them from taking over Europe, and everybody wanted to get paid back, to the point that the Germans just couldn't pay it back. They did all kinds of crazy gimmicks, changed currencies, printed money, had hyperinflation, and eventually, because the world was so tough on Germany, it ended up collapsing the whole global economy. So from that point of view, you can see that China's in trouble, and they've been taking advantage of everyone. Now we're all trying to punish them. And short term, sure, that might create some quantitative easing and all that. But if the pressure persists for a long period of time, this could certainly cause another global recession. Same story is true with the with the Russian Cold War set up in the from 45 through, I think, 90. And so, just because the last two crashes were short-lived and quickly rebounded, doesn't mean the next one would necessarily be like that. So how do the central banks look at inflation? Here's the current setup, but it's important to note that they adjust these as they see fit to keep that CPI low. So here's a current CPI index. And most likely this only goes back to 1989, so it's sidestepping that huge period of time where we had inflation in America. My expectations is, again, these rates go back down to zero. You can see this band it's been traveling in, and that's really as low as it can go. At that point, probably the Fed runs out of ammunition to save the markets, and we finally go into a period of trying to change the inequality gap, big transfer of wealth, and we got to start paying off all these debts that the world's accumulated. So that's where you get your higher interest rates, you get your crashing stock markets, you get your next long-term depression. And if Ray Dalio is correct, we're looking at a 10-year correction, not a one-year little mini cycle. Here are some of the times where inflation has come roaring. So again, inflation is really the one thing you need to worry about in retirement with your assets. Keep a close eye on whatever they say is the CPI, because that's what's going to dictate whether they start to raise interest rates, which again is the nightmare for both stock market and the bond market. Now, maybe it's good for economy, gets rid of all the bad investments out there. From that perspective, it's a good thing. Now, being one of the few people to predict and understand this sets you up to make a lot of money. But for everyone else out there, they have no clue what's potentially coming. What causes inflation? Well, of course, increasing the money supply. Why don't we see inflation yet? Well, the way they're doing it, loan money to the banks, banks loan money to the corporations, corporations buy back their own stocks. None of the money is getting into the system. So it won't be long, most likely until they start trying to directly feed money to the government instead of to the banks, and then let the government do a lot of subsidies that help out your average Joe person, which will certainly put pressure on prices, because now the 90% of the money won't be just sitting in the stock, real estate, bond market. We're going to have most of it going to the people who actually spend the money. So if we do look at the time there's been spikes in inflation, you can see it comes out of nowhere and spikes up hard and fast. That's really what will create the end of this current business cycle. Here's our federal funds rate. So again, most likely this will go down to zero. I'm going to print a ton of money. Markets will all bubble up even further, and then we reverse this cycle. And so you can see the cycle's something like 15 to 20 years to go from the peak. This is the period of where we raised the interest rates all the way to 20%, insane, from 0%. So the big prediction with Ray Dalio is that this whole chart is going to reverse itself over the next several decades. And that we're getting towards the end of that period. Now, if we compare the CPI to the federal funds rate, you can see they're very correlated. And question is inflation headed our way? If so, the Fed will have to keep their federal funds rate above the inflation rate. And so that's really what's controlling that. Now, every time they do spike the rates, what happens? Well, there's your very few negative GDP prints in history are directly after cutting off the money supply. So every time that yellow line spikes up, you can see GDP crashes. Funny. Also, that federal fund rate is directly controlling the 30-year treasury, which is the primary asset in our TLT. So again, if we know what's happening with inflation, we can have a good idea of what's going to happen to the TLT. Now they manipulate the CPI to keep that rate low to support the banks because they don't want to crash the financial system. So here is the inflation broken down by sector. You can see most of it's flowing into industries that have been subsidized by the government, namely the housing sector, which of course was the last bailout in 2008, and now medical is being heavily supported by the government. Everything that's been supported by the government has had massive inflation. Here's another chart. Look at the college. So Obama came in and guaranteed the banks that, don't worry, loan money to students with no jobs or credit, and we will back those loans. And so that's one loan you can't get out of with bankruptcy. And so colleges are not stupid. Second they saw that, they started racketing up the prices of college tuition. The cumulative change from CPI is alarming. So these prices that they are tracking, even with manipulating it, changing it, have gone up significantly over the last 2 decades. So most things we're used to paying for are up over 50%. And that's the cumulative change, even with these low average inflations around 1 to 2%. Now, if you go to shadow stats, they can show you what these inflation rates look like if you just had kept the calculation the same in 1990. And so inflation's much higher. So the federal funds rate should be around 4.5% to 5%, not 1.75% like it is right now. So they're clearly altering the data to try to keep these rates low. And if you go back to 1980, it's much worse. You know, we're looking at inflation more like 10%. So clearly the big picture is inflation is coming because they have printed a ton of money, and it just needs to escape these different financial markets to work their way through the system. As far as trying to predict when that turn is going to happen, most likely we'll see unemployment rate spike up right before a recession. So I think we're still early on that stage. Here's your historic CPI. So again, you can see trading around that. Let's see, we got a chat box. Let me pull this up. Okay, so next in the presentation, I start to look at some of these periods that had inflation or deflation. So now there wasn't a federal funds rate necessarily in early 1900s. We were still on the gold standard. And what ended up happening during this period is America loaned a ton of money to Europe. And bottom line is we became super rich. We had almost something like, I can't remember exactly, we had the majority of the gold supply around the world, which is how the monetary system worked at that point. And it created, it made it too hard for money to flow between countries and created a bad imbalance that eventually created inflation and then deflation. And the only thing that got us out of that was President Roosevelt came in and started manipulating gold prices. I can't remember exactly what he did, but it was similar to the effects of QE, and immediately got out of there. We had the roaring 20s, and then lots of subsidies, lots of money printing, and we eventually got another round of inflation and deflation. So around this time, they came up with the idea of getting rid of the gold standard and trying a new system, the peg system. And so we can look at these two periods right here. During the 1920s, the Dow went from 1,000 to 5,500. And then we had a crash right back to where it was. The next big period to pay attention to is post-World War II, and similar setup, start printing lots of money, lots of subsidies, and eventually we got massive, massive inflation by the 70s. So you can see printing money, lots of subsidies. Initially, it was very bullish from 47 through 65, getting out of World War II and entering into the Cold War phase. Huge rallies in equities prices from 2,000 up to 8,000. That's a, what is that? 200% return. But then we got massive inflation, and then there's that period of time we all need to look out for, from 1965 to 1980. And let's look at interest rates during that time. We had to fight off inflation, and so they were jacking up the rates all the way to extremely high interest rates, as high as 20%. And then we had a period of the opposite, where inflation was dying down, and we have the roaring 80s all the way to the tech bubble with almost nothing to stop it until you got it. Inflation came back up and they started hiking rates. I think that's about as far as I've gotten so far in this whole presentation. But if we just focus on inflation, interest rates, we can really, and the Fed's balance sheet, you can really get a good gauge of how to play our simple SPY TLT setup right there. All right, guys, any questions? All righty, well, I really appreciate everyone's time, and tomorrow we will have our TLT trade come off, and then Friday we'll see. I'm wanting to hop into that upside down collar and bet down on the SPY, but we got the Powell put right now, so it's difficult to make that call. We need a catalyst. We need Trump to tweet something really upset, and then I'll give you guys that down play on the SPY. All right, thank you, everyone. Appreciate your time as usual, and hope to see you on the live stream tomorrow.
Thanks, Jason. Appreciate it, bud.
Yep.